Hello and welcome back to Miss Finance. So today we're going to go over a set of financial statements and really get into where items sit on a TB, where they sit on a balance sheet and where they sit on an income statement. So let's start by drawing out a TB. Okay, so what we're going to start off with is opening inventory, purchases and sales revenue. So over here, I'm going to give something a number 1 if it sits on the statement of the profit and loss, and if it sits on the statement of financial position, I'm going to give it a number 2. So down here, open inventory, purchases and sales revenue all sit on the statement of profit and loss. So these two top items here actually sit in cost of sales, and sales revenue sits in income. So if I had here 10k, purchases is 105k, and then sales revenue is going to be 100k. Let's move on to other items that we find in the P&L. So let's have wages, which again is in the P&L and it's a debit in the P&L, so let's have 6k. Then we have rent paid of 7k, travel of 2k, and then we've got sundry of 1k there. So if we're just purely looking at this bit here, let's get the calculator out and see what our profit is for the period. So we've got 10 plus 105 minus 100 plus 6 plus 7 plus 2 plus 1. So in this case, we've actually made a loss of 31k because our sales doesn't cover all of our purchases and all of our admin expenses there. So the wages, the rent, the travel, the sundry. So let's just write over here that we have a loss of 31k. So let's change the colour here. So we're going to go into the statement of financial position. So when you look at a statement of financial position, it tends to be listed in order of liquidity. Let's go to the very top. So we have got fixtures, which are a fixed asset of, again, 100k. We've got the trade debtors, which is also known as the receivables or sales ledger control account. We've got 10k there. Then we've got cash, which is 20k. So all of these are assets, hence why they're a debit. So when you're looking at the P&L, any items that are an expense are a debit, and any items that are revenue or income of any kind are a credit. But the opposite is on the balance sheet. So your assets are debits and your liabilities are credits. So next we've got a loan, which is a liability, which is 50k. And then we've got equity is our retained earnings brought forward. So all of the profit and loss from prior periods brought forward. So here we have equity brought forward, so retained earnings brought forward of 111k. But we've made a loss of 31k. So what we actually have is 111k minus 31k, which gets us to 80k. If I put 80k here, and what we'll see here is that this 100k, the 10k and the 20k nets off with the 50k and the 80k in the statement of financial position. So all of this, just change the colour slightly. So all of this here nets off, and this loss is transferred into equity on the statement of financial position. So let's have a look at the layout that they show you at AAT for the statement of profit and loss. So they refer to this as SPL a lot of the time. So what we have is sales revenue, and we're just going to have a debit over here and a credit over here. So sales revenue is a credit in the statement of profit and loss. So that will appear over here. You have opening inventory. So that is whatever the closing inventory for last year was in the statement of financial position. So this is a debit. And then you have purchases, which costs are a debit. And then we have closing inventory. So we want to take closing inventory off this, which looks like that. And then we've got the total cost of sales. It's a tiny bit smaller. Next we've got gross profit. Now, depending on whether the sales revenue covers all of the cost of sales, you'll either have a positive gross profit or a negative gross profit. If sales are more than cost of sales, then you're going to have a credit gross profit. So that will show as a positive on your statement of profit and loss. Next we've got expenses, so we have admin and wages. So these, as we know, are debits, and then we'll have total admin expenses. Again, let's make that a tiny bit smaller. There we go. And then we have profit for the year. So again, if all of your sales is more than your total expenses in the year, then you're going to have a credit profit for the year, but that will show as a positive on the actual statement of profit and loss. So I'm just trying to show you the debits and credits here. So if we were to change this, instead of showing you the debits and credits, it would look like this. So you'd have X, so you'd have your sales revenue here, then you'd have your cost of sales like this, your gross profit like this, and then you'd have your admin expenses, but your total admin expenses would be here, and then your profit for the year would show as a positive like that. So let's move on to the statement of financial position, or SOFP. So we're going to start off with non-current assets. So these are long-term assets basically. So these will be things like land and buildings, property and equipment. And then we'll have current assets, where we might have inventory, trade receivables, bank, and then our total assets. So if they were all positive there, then our total assets would be the total of these assets up here and these assets down here. So again, let's try and make that a bit smaller so we can fit it all on. So let's move on to the liabilities. So here we have current liabilities, and here we have accruals, trade payables, VAT or value added tax, and then we have a total current liabilities. Then we might have some non-current liabilities, so these are long-term liabilities, and here you're going to have things like loans. Again, just making that small so that we can fit more on. So you're going to have something called net assets, which is the total of all of your assets up here, so all of these, and then all of your current liabilities and all of your non-current liabilities. So say if that there was 100k, what you'll see down here is that this is all financed by capital. So this will be broken up by opening capital or opening reserves, your profit or your loss for the period, less any drawings, and that'll give you your closing capital. Just like that. And what you'll find is that this also equals 100k. So the total of all your profit in the year plus all of your retained earnings or opening capital brought forward is going to equal the total of your assets and your liabilities. Now, one thing that you might be confused about is that when you look at the debit and credits, so over here, capital down here is actually a negative, okay? So all of your assets here are obviously all debits. All your liabilities over here are credits. So if assets are more than liabilities, you're going to have a positive for net assets down here, and equally you're going to have a credit to capital. Now that's because capital is a liability in effect. So remember in your studies to say that a company is a separate entity to the owners. Well, capital is a liability because it's what the business owes to the owners or the owner, because it reflects the investment of the owner or owners at the end of the year. So if this was a limited company, you'd see the word equity down here instead of capital. So I hope you found this video useful. If you did, then please do hit the like button because it helps with the YouTube algorithm, and also consider subscribing. But otherwise I shall see you on the next video.